Hey, good afternoon, everybody. This is Craig Modelmog with this week's episode of Wall Street X's and O's. It is Friday, April 9th. It's hard to believe we're in April. I tell you, we're already through the first quarter of the year. We have earnings season starting next week, which I'm really fired up about because I think earnings for Q1 are going to be good. I think Q2 is going to be off the charts because when you think about earnings, they compare not just quarter to quarter. The big one is year over year. So if you think about it, we've got quarter number 2 in 2021 that will be compared to quarter number 2 in 2020, which was the height of the economic shutdown due to the pandemic. So I think we're going to see Q2 numbers off the charts. GDP numbers are probably going to could be double digits, 10, 11%. Earnings are going to be off the charts because their comps that they're going to compare against year over year are going to be so low that they're saying we haven't seen numbers, or we may not have seen numbers like they're projecting or anticipating since the 1950s. So we shall see. But anyway, before I kick things off, a little disclaimer. I forgot this last week. Some days you just don't have it. It just happens, we'll blame it on nothing other than sometimes you miss it. But anyway, disclosure, the thoughts and opinions on this show are mine. They are not either an offer to buy or sell any investments. Investments can and will lose money, and they are not FDIC insured. So there we have it. Top 3 things today. We're going to talk about our inflation. Number 2 is volatility. Number 3 is the current Wall Street positioning. This is a good one. And then I'm going to close it out, kind of my thoughts for the year. But anyway, March Madness just ended. Basketball season is over. Now we have to watch bad Rockies baseball. Although John Gray threw a gem last night, so I'm still anxious to see how the Rocks do, and hopefully they have a good year. But anyway, if you are a Baylor Bear fan, golf clap for the Baylor Bears. I'm a Big 12 supporter. They were awesome. Gonzaga fans, you got beat by a better team. Okay. Just be honest, all right? Baylor got in your grill from the get-go. They pinned you down, and just like the bully does, they smacked you around the whole game. And it was kind of a boring game to watch, honestly. But anyway, good for Baylor. First win, maybe ever. I don't even know. I'm not, like I said, I don't track the Baylor Bears. But anyway, good for them. But anyway, let's get on to inflation. This is a big deal, okay? Because the U.S. dollar and the growth of the economy are causing inflation. And I've got some inflationary numbers that are really, really going to shock you. Just to prove this, I find it interesting how the government, how the Fed, how the new Treasury Secretary, they're talking inflation. Yeah, we're going to let inflation run a little hotter, but inflation is still really not out of control. I would beg to differ. I think we could see what I'm going to call a minor spike. We're not going to see any major spikes like we saw back in the late 70s when inflation was running away. Interest rates were through the roof. For those of you that remember those days, they were not good. I don't think we see anything like that, but I do think we're going to see a very quick rise and a spike, which could provide a shock. When will that happen? I'm saying Q3-ish, okay? Because it's taken place, it's starting to take hold. We'll see if it continues. That's the kicker. But if you look at a couple things, we still are in an environment where we have growth continuing to accelerate along with inflation. Okay? We're seeing inflation in these areas. And here's a couple stats for you. Used car prices. If you're going out to buy a used car right now, I would say don't. Why? They are up 26% since this time last year. Year over year, used car prices are up 26%. And for the first 3 weeks of March, okay, and we don't have the 4th week, that's why I don't have this stat, used car prices rose 1.7% per week for the first 3 weeks in March, and they are accelerating. So that's going to be interesting to watch. Lumber prices, get into home prices. Lumber prices year over year are up 200 and 24%. Okay. When you get into the home buying world, you're seeing this shift from new to existing. Why? The cost of building supplies is through the stinking roof. Okay, if lumber prices are up 224%, think about this. Who is that increase in cost being passed to? It's not the builders, it's the buyers. So while I know here in Fort Collins, we're still seeing building, it is slowing. Nationally, it's definitely slowing. And in fact, if you look at it on average, there normally are 1.2 million homes for sale at any given time. Right now, there's 500,000. Okay. So I'm anxious to see how this continues. What I really think is could crimp it is if interest rates continue to rise, which they are rising. I anticipate a continued increase from here. How much higher? I don't know. We're going to see. It's going to get interesting, though. Some other inflationary numbers here to touch on. These are your main commodities. Lean hog prices, which I know you all are tracking pork bellies, right? It's up 45.7% year to date, which is crazy. Crude oil is up 21%. Heating oil 19, platinum 14, copper 14, corn 13%. So if you're a cornflake fan or a corn chip fan, they're probably more expensive. Soybeans up 9, natural gas 7, cotton 4, live cattle 3. But here's some big ones. Year over year, crude oil up 107%. Copper up 84%. That's a big measuring stick from a standpoint of industrials accelerating. Silver's up 73, heating oil's up 70, lean hogs up 66, cotton for clothing up 60%, corn is up 59.4. These are big numbers. That's why when you look at the data and you look at the facts and then you hear what the Fed is reporting, I'm calling the full one on this. This is the full bull, double-handed. I'm double fisting you on the full bull, so I don't buy it. Okay, inflation is real. I think we're going to see a spike here on the short run. Again, nothing major. I do think we're going to see one. Volatility. Let's shift gears here. Volatility continues to drop, which I find interesting because usually, just to give you the teeter-totter effect, as volatility goes up, we usually see the stock markets go down. They're inversely correlated, as I like to say. Volatility is dropping. What's happening to the markets? Well, we keep hitting new high. We hit another new high, all-time new high, I think today in the S&P. S&P closed at 4,128, which is getting up there. Most likely, if volatility stays low, I think we have more room to run on the upside. The VIX today closed down 0.26 at 16.69. The NASDAQ VIX, so NASDAQ volatility, closed down as well at 23.23. Russell 2000, which is small caps, closed down 0.54 at 27.01. So you've got the VIX in general, you've got the NASDAQ VIX, and you've got the small cap VIX all continuing to drop. I anticipate markets continue to rise. I think we're going through a little sector rotation here where the high-flying tech people, which have been lagging, are slowly being replaced by new leadership in energy, in industrials, in material, and in financials. Those are what I'm going to call the four horsemen, okay? So we're seeing new leadership. And with volatility continuing to decline, we're seeing participation in the market expand. This market's going to continue to go up for a little while. How much longer? I think through the second quarter for sure. As we get into the third quarter, I think things could change. But for now, the data is showing continued growth in the economy and growth in or increase in inflation. So those two things right there are going to keep stocks continuing to rise. They're going to keep gold continuing to drop, and we're going to see interest rates continue to tick higher. It's going to be fun to watch. Current Wall Street positioning, I'm going to transition into here. This is what's fascinating, okay? Goldman Sachs came out with a note about 10 days ago, and they were saying how the average hedge fund's performance year to date is minus. I think it was between 2.5% and 3% on average. We're definitely not there. We're the opposite of that, and up significantly more in some cases. So why? Here's the deal. When you track the narratives, when you get my quarterly newsletter for this quarter, I talk about the narratives and how the narratives drive the economy in many cases on the short run, and how we need to pay attention to those. And sometimes it's going the opposite direction. Case in point, right now, Wall Street is net negative from a standpoint of how they're positioned. What do I mean by that? They are short the Dow Jones, the S&P 500, the NASDAQ, and the Russell 2000, which is small cap stocks. What does short mean? It means this. If you are long a stock, it means you think that stock is going up. Okay, if you're a hedge fund or an institution, you can short stocks, which means you are betting or thinking that those stocks or the markets are going to go down. They will sometimes use that to hedge portfolios also. Right now, when I say they have a net negative position, it means that across the board in U.S. equities, they are bearish, which means they think the markets are going to go down, and that's how they are going to make money. What is happening? The markets keep going up. What I'm waiting for is this. Eventually, they cry uncle and start reducing shorts and go back to the long side, and that's where you get what they call short covering. It means they're covering their shorts, which is negative, and they're going long, and you see a pop in the market. What kind of pop could we see? I do not know, but I continue to watch the CFTC futures, which gets reported weekly, and it helps the Federal Reserve get a gauge for how institutions are positioned, which is important to them. They want to know, hey, where are the bets and how big are they? Well, right now, they're slightly negative. They're nothing major, but still, the fact that they're all negative is pretty interesting. So I'm anxious to see as they start pulling off their shorts, are we going to see this reflected on the long side, which means markets going up? I think yes, and that's how we are positioned currently. All right. I think we see small caps continue their march higher. I think we see large cap continue to march higher. I'm watching the growth because growth has underperformed significantly the last couple quarters. I'm anxious to see if that re-engages and re-accelerates. That's where we're going to see it if we do. But it's going to be fun to watch. So again, stay tuned, okay? Because that's where what I'm watching and how I'm continuing to be positioned. I think we see interest rates continue to go up. I think we see the dollar continue to drop. I think we see inflation continue to rise, and I think we see the markets continue to melt up. We could see a little bit of a pop. It's going to be fun to watch. Anyway, in closing, I'm titling 2021 the year of change. Here is why. We have the first big change was Democrats ran the table. They own the presidency. They also control the House and the Senate. Okay, we have a new agenda called government activism. We're seeing the U.S. government get bigger. That's what's happening. We're seeing record spending off the charts. We're seeing more regulation instead of deregulation. We're seeing a potential for higher taxes in corporations and upper income earners. That is probably a given. We're going to see a continuation of record-breaking stimulus. We saw Trump do a big plan. Biden had to one-up him, and we're going to see a big infrastructure plan, which they're titling it as infrastructure. It's not. It's all sorts of stuff. Okay, so lots of spending. We're going to see the continued rollout of COVID vaccines. We're going to see an unleashing of pent-up consumer and business demand. What that is going to look like, we'll see, because there's a lot of pent-up demand that really doesn't exist. But then there are things like spending. We have $1.9 trillion that people have saved. You're seeing retail start to reawaken. You're seeing people start to anticipate spending more money. So I do think we are going to see a move here into the next couple quarters. How that is going to be interpreted by the markets is yet to be seen. It's going to be exciting. These are historical times, and I'm having a blast, and I'm very optimistic on the short run about the markets, and you should be too. So anyway, thanks for joining me today. This is Craig Modelmog. It is Friday, March 9th. March 9th. Dang nabbit, it is Friday, April 9th. I'm shocked. I'm still getting over 2019 being over, and we're in 2021. But anyway, for Friday, April 9th, this is Craig Modelmog. Thank you for joining me today. I hope you've enjoyed this as much as I have. I hope this information really helps start filling in some of the gaps that we aren't hearing out there in the news. That is my whole focus, is to help educate you and inform you about the things that matter to help us be what? More disciplined investors. Craig Modelmog, and I am out. Thanks for joining me.